So joining me now is Nancy Tengler, CEO and Chief Investment Officer of Tengler Investments. So give me the explanation here. What is it that you see that makes you a buyer today?
Oh, thanks for having me, Eamon. Well, we were adding to our tech holdings in the fall of last year, and part of it was valuation. We already were overweight the group, and we are still overweight technology. But much of it was that the companies were turning in solid earnings last year, some in the 20% range. They would pop on the earnings announcement and then sell off in subsequent days because investors were valuing the stocks based on interest rates. So the Fed now is closer to being done. We know the economy is slowing, and we always want to own companies that have solid, sustainable earnings power in a slowing growth environment. And many of the names that we own have that. And then in addition, we now have the AI tailwind, and it's a secular tailwind, I believe, along with cloud not even being close to half done with the total addressable market of $3 trillion.
And Nancy, I teased this at the very top of the show. You like tech, but you like only a certain type of tech. As I'm looking at the names here that you picked, you kind of like big establishment tech, right? Explain why.
Yeah, and because the management teams have demonstrated that they can continue to take share and
they know what they're doing.
Yeah, a pretty treacherous environment. We also like the ones that are paying a dividend and growing the dividend. So on that list was Broadcom and Oracle, Microsoft, all pay a dividend, and they are growing the dividend. Great offset against inflation.
Can you pick one of those against the others, or are they all in a basket? You would equally weight them all?
No, we are overweight. We have a 12 best ideas portfolio, and in that, probably Microsoft is the highest weight, just on sheer appreciation. You have to also pay attention to what you're paying for a future unit of growth, and the PEG ratio on Microsoft is 2.3 times. Palo Alto Networks 2 times. So this is not the internet bubble valuations that people were sort of stating last year. This is not that. These are companies that have solid earnings power, growing, and they're in the right spaces. Because you just had that segment on labor force limitations. The participation rate overall is not going to go up. You're not going to bring the baby boomers back. So we need productivity.
You can't get higher than 100%.
Yeah.
There's a ceiling on this.
Yeah.
So I guess my question is, one of the takeaways, my read of the jobs report anyway, is that we're continuing that rebalancing post-pandemic from the idea of everyone buying stuff and being in their houses to everybody buying services and getting out of their houses. That shift seems to be going, incredibly fast and continuing, and who knows how long it'll continue to last. But I wonder, as you look at that, are there particular stocks that you would look at that could still benefit? Is there still some running room to that trade?
Yeah, I think so. I mean, we were also adding to consumer discretionary last year. It seems counterintuitive, but we think a number of those names still have a ways to go. So a name like Lululemon or Spotify is not a consumer discretionary, but it is purchased by consumers. We just added to Uber. We think that is going to continue to provide solid management and outperformance because people are, returning to travel, and that you need to get around when you get where you're going. Yeah. So we like those kinds of names that have demonstrated the ability to grow last year and in this slowing economic environment.
So you're sticking with that theme of the big companies where management knows what it's doing. Nancy Tengler, thanks so much with Tengler Investments. Appreciate your insights today.